Are you letting politics control your portfolio? It's time to stop. Welcome to the Lawyer Millionaire, where we deliver financial planning insights for ambitious law firm owners so you can enjoy more time, more abundance, and less stress, even if you're still growing your practice. As election season ramps up, you might be wondering if you should adjust your investments based on who wins or who you think might win. It's a common concern, but one that could cost you dearly in the long run. Today, we're going to break down why investing based on politics is a bad idea and how you can protect your financial future from the short-term political noise. Here's the hard truth, friends. If you've been moving your money in and out of the market based on who's sitting in the White House, you've been making one of the worst financial mistakes possible. Hey, law firm owners, welcome to today's episode. I'm so glad that you're here with me today. We're going to talk about why investing based on politics is a bad idea. So let's dive in. Did you know that if you had only invested during Republican presidencies since 1953, your $10,000, let's say you put $10,000 in 1953, only during those segments where Republicans controlled the White House, your $10,000 today would be $83,000. Now, if you'd gone and done the same thing, but only for Democratic presidencies since 1953, it would have grown to $254,000. Now, before you start thinking that we should be investing during Democratic presidencies and not Republican presidencies, let me just tell you, if you had ignored politics altogether and stayed invested from 1953 to today, your $10,000 would be worth over $2.1 million. Let that sink in for a minute. That's a huge difference. That's a tenfold difference. I mean, that's just bizarrely incredible. And to, there have been some very, very different presidencies over the years. So why are so many investors letting politics dictate their financial strategy? And, this might seem like it's duh, right? But you'd be surprised by the number of people that I talk with who have this idea that, oh my gosh, if someone gets into the White House, I'm pulling all my money out of the market. I talk to these people who have this, these thoughts all the time. So this is actually a lot more common than you might think. But why do people let this distract them, even when we know empirically that chasing this kind of a strategy is a losing idea? Well, a lot of it has to do with our emotions. It's easy to let our emotions get in the way. In fact, I think in the news, there was some big hedge fund guy who was threatening he's going to pull billions of dollars out of the stock market if I don't forget who he was against. I think maybe it was Harris. If Harris gets into the presidency, he said he's going to pull billions of dollars out of the stock market. Well, so, clearly this kind of stuff impacts even sophisticated investors who are wealthy, right? This is not just something that, us smaller peons are affected by, but it really all comes down to our emotions and to our sense of control. As business owners, we often thrive on control. We want to believe that we can anticipate every market shift and protect our assets accordingly. And I find this is especially common among law firm owners who kind of manage their own investments. They think they can know and anticipate what's going to happen. Oftentimes that's a myth. And so many people have been tricked, deceived into thinking that they can outsmart the market, and the market has outsmarted them. Friends, the stock market responds more to earnings, valuations, and global economic trends than to whoever is sitting in the Oval Office. That's the hard reality. There are so many more things that are so much more valuable. In fact, many of the policies that we think will impact the economy take years to play out, or they get stuck in political gridlock. I mean, politicians promise all these great, wonderful things. And the truth is they really only can accomplish a very small amount of the things that they promise because we have checks and balances in government. So, as business owners, we need to separate our emotions from our financial decisions. That's number one. And we need to let go of this idea that we can really control or outsmart the market. Let's dive a little bit deeper into why political decisions don't drive performance. Politicians make promises, but our government system of checks and balances often means that these promises either one, never happen, or two, take a long time to come into effect. You know, Even executive orders can be challenged in court and overturned. So it's not like presidents have free reign to do whatever they want. Meanwhile, market fundamentals, things like corporate earnings, interest rates, these are the things that really drive stock prices. And there is a huge, wide range of factors that affect the stock market's movements, which are completely separate from the political landscape. Let's look at an example. 2016 election. That was a very contentious election. And by the way, it seems like why are we having this conversation, right? I mean, it feels like this should be a known fact, but it just seems like every election things get more and more bizarre and crazy and contentious. But 2016 was a contentious election for sure, right? You had Trump and you had Clinton going at it, and there was widespread fear, on both sides really. But there was a lot of fear that if Trump was elected, there would cause there would be all this market volatility, right? Well, he won, and the S&P 500 gained over 20% in the first year after his election. Likewise, many fear that Biden's win, if he won in 2020, the market would tank. The reality, the S&P 500 gained over 16% in his first year. So those are just two very small examples where there was fear, that there would be a, market panic if one president was elected. Here's the interesting thing. For every person who feels like one candidate is going to tank the market, there's another person who feels the exact opposite, right? So you have people over here who feel like, if this happens, the market's going to tank, and people over here who feel like if the opposite happens, the market's going to tank. And then, no one ends up being right, usually. But these examples should illustrate that political outcomes don't always, align with market expectations. And making investment decisions based on fear or hope in an election can really, really cost you. Let's talk about some ways that you can kind of get away from this idea and give yourself some more balance. Number one, core ideas that have always worked. I have said this, as an avid weightlifter, I go to gyms and I see all the time, I see people doing crazy things. The reality is the basics have always worked when it comes to exercise and eating healthy, right? The basics work, the basic fundamentals of weightlifting. I think Arnold Schwarzenegger talked about that. The same thing applies to investing. The basics work. The basic time-tested core principles work. Now, you can do extra things, right? Stock picking. You see a stock you really believe in, you want to add it to your portfolio, great. But the core principles should make up the core of your portfolio. That should always be the case. Number one is diversification. Such an overused term, but so critical. Make sure your investments are spread out among different asset classes. The bulk of your portfolio should be the market, should be the S&P 500. And then you could have satellite investments that are, stacked on top of that. But the foundation, you have to have the foundation. And having that foundation and having proper diversification is going to protect you from political volatility and short-term events. Second thing, and we hear this all the time, but it is worth repeating, the long-term focus. And, we hear these words, but we don't think about what they mean. Long-term focus doesn't mean I'm concerned about looking to next year, looking 12 months out. No. Long-term focus means I'm 35. I'm focused on what things are going to look like when I'm 65. Okay. That's a big difference. That's a big zoom out, right? Zoom way out for a minute. And then it's like, okay, well, what happens in November really doesn't matter because I'm thinking about the year 2074, or 64, or 74 might be a little long, 54, right? I'm focused way out from here. I'm focused, decades away. Now, if you're closer to retirement, you may not have such a long-term focus. There's the retirement red zone, we call it, which is those 5 years just before and 5 years just after retirement. Those are the most critical years where volatility in your portfolio can have the biggest impact. We call that sequence of returns risk. Yes. Bet you didn't know we were so savvy about investments. We talk a lot about law firms and growth and business strategy, but the core of our business, is at the end of the day, we started out as investment strategists. So that's when you need to protect yourself from portfolio volatility. But there are better ways to do that than pulling your money out of the market or panicking because some political outcome that you're concerned about. Remember, your investments should be aligned with your long-term goals, not short-term political shifts. And we have seen some huge examples of this over the last 5 years. And when there have been these panics, if you had pulled your money out of the market during any of these panics that we've had, you lost big time because and then struggled to know when to get back in. That is not the name of the game. Markets go up and down. Staying invested is really the key. A third principle for you: rebalance, don't react. That is the one action that you could take. If you have a portfolio allocation that your portfolio should be sticking to, if you're concerned about what may happen, rebalance. Bring your portfolio back into line with the targets that you've set for your different asset classes. That's the one action that you can take, and let that give you some hope, some confidence, right? You're aligned, you're following your strategy, right? Instead of making sudden moves based on political events, stick to your disciplined approach. This is easier said than done because disciplined approach means I'm not going to touch my portfolio for the next 4 or 5 years. That can be hard to do. I see investors all the time who are, change their strategy a couple times a year and they're never successful and they never make money. That's the reality. If you're always changing your strategy, you're never going to be successful with investing. You've got to stick to a plan and stick to it long term. So rebalancing your portfolio simply means bringing it back in line with your target allocations and ensures that you stay on track and you're not letting your emotions get the best of you. A couple examples I want to look at, historically of moments where events caused fear, but the market ultimately rewarded the people who stayed invested. The post 9/11 recovery. After September 11th, the market saw a very sharp decline. A lot of people panicked. A lot of people pulled their money out of the market. What's happening? The sky's falling. The world's ending, right? People who stayed invested saw a very strong recovery years later. It took some time, but when the market rebounded over the next few years, they made a lot of money. 2008 financial crisis. That was another time we thought the world was ending. Yeah. Look at a chart of the S&P 500, go back to 2008. It's a tiny blip now. It was a huge event. Market went down 50%. Many feared that drastic, that was a time of political turmoil too, by the way, because, at the very bottom of the market was when President Obama was taking over from Bush. And a lot of people were terrified, right? That, the world was going to end, that he's going to harm the market. Well, actually, that was the moment to get invested because that's when the market actually started to recover. Again, there's nothing to do with politics. It's just the way that events unfolded. And actually the people who stayed invested saw a huge bull market run over the next 2 terms, really. So another example, of course, would be when President Biden took office. There was widespread fear about inflation, which has been calming down. I know prices are still high, and just because inflation is calming down doesn't mean prices are calming down. You know what I mean? But 2022, we saw kind of a bear market with the stock market. We did see a bear market. There's a lot of concern about inflation, and there was a lot of concern about market volatility due to spending, and the infrastructure bill and things like that. Market shrugged that off, and look where it is today. Now, watch, I'm going to eat my words. A year from now, we're going to be in a bear market. Who knows? But the market historically has always gone higher over time. Sure, there's volatility along the way, but things keep moving up. There's some psychology behind why and how we allow political bias to affect us. A couple of good ones we like to talk about: confirmation bias. Confirmation bias is something we see in investing and something we definitely see in politics. Confirmation bias is where you seek out information that confirms your bias. And this is what Facebook and social media does to us, because the algorithms feed us the stuff we like to see. So if you have one particular political persuasion, you're going to see stuff that's going to lead you further and further in that direction. One reason I kind of avoid social media, in terms of politics completely. I just watch the funny videos or the videos about law firms that I find interesting and engaging. But this happens with investors, maybe who are seeking out information that aligns with their political beliefs, and then they start to believe that more and more. And then that leads them to make investment decisions based on emotions rather than facts, because they're not taking an objective view. This is especially common during election seasons, because there's so much happening in the media, and there's so much, it's like all of our collective emotions are just ramped up, right? And so we're especially prone to this during these time periods. Another one is the recency bias. The recency bias is where you place more weight on recent information than all the information, right? So what happens here is when investors often place too much weight on recent events, assuming the current political environment will have long-lasting impacts on their portfolios. However, markets have a way of rebounding. This happens when markets are, falling. We see the recency bias. Markets are falling; they're always going to be falling. Oh my gosh, right? And then finally, just fear and greed. As I mentioned, politics they stir up emotions. Politics stirs up emotions, and when the party we don't support is in power, we fear the worst. But you got to realize that there are other people on the other side who fear a completely opposite thing. You know what I mean? And vice versa, when the party we support wins, we may be overconfident, and that can lead us to make bad investment decisions. Both emotions can lead to poor decisions, either overconfidence or irrational fear. If we understand these biases and our human nature, our human tendency to have these biases, we can avoid making bad decisions. So what's your next step? If you're concerned about how politics might affect your portfolio, take a deep breath. Refocus on your long-term goals. Don't let the headlines dictate your financial future. And here's my challenge to you. The next time the political headlines make you anxious about your investments, resist the urge to react. Remember, it's not politics that builds wealth. It's patience, discipline, staying the course. Ask Warren Buffett. Don't let short-term political drama distract you from your long-term financial goals. At the end of the day, building wealth is about having a strategy that works, no matter who's in power. And as a law firm owner, your portfolio should be working as hard for you as you are for your clients. If you need help creating a rock-solid investment strategy that's built for the long term, we are here to guide you. Got two things for you. You can download our PDF, or I'm going to put that in the show notes, on why investing based on politics is a bad idea. Put that in there for you. There's a great chart there to show that. And if you want help designing an optimized investment strategy to reach your financial goals, schedule an introductory call with me. I'll put the link in the show notes below. This has been the Lawyer Millionaire Podcast. I'm your host, Darren Wurz. Thank you so much for joining me on this journey to expand your business, maximize your profits, and secure your financial future. I can't wait to connect with you again next time. Until then, take care and keep pushing forward.